Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about the QQQ. That is an ETF that tracks the NASDAQ. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we talked about the QQQ. That is an ETF that tracks the NASDAQ. And we are doing a special edition of the overtime because on Friday, the markets will be closed. And it just so happens that it's even a more special edition, as I highlight here on my dashboard of my Ally Invest test account here. We see that the S&P 500 index reached 4,000. I didn't have enough time to get my t-shirt printed for it, but today we're up 37 points, 4,010 as we approach the close. So I think it would be excellent if we could actually get a close on a holiday week of trading. And we highlight here inside the Ally Invest platform that the markets will be closed this Friday, April 2nd. So with that said, we've been talking forever about the VIX index. So let me scroll down here on my VIX watch list and we'll see ding, 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 ding. We are below 18% on the volatility index. It's trading at 1780. And over here on the right-hand side on my screen, I'm showing that chart. So here was the downturn. Here was the 20 level that the VIX skyrocketed through, gapped all the way up. And all the way over to the end here, we finally see, look at that. We got a red mark quite a bit below that 20 level. So for the first time, we're seeing the S&P 500 index break through the 4,000 level. We're seeing the VIX break through the 18% level. And now I go all the way up to that April futures contract, which there's only a few more days remaining until that April future will be expiring. But with that said, now that's all the way down to the 20 level. And then we see the May contract, that's down to the 22 level. It took forever for these futures contracts to break below the 25% level overall. So what does this mean to the marketplace? Well, ideally, we're just basically saying that there's a little less uncertainty. We kept hitting new highs in the marketplace after the March lows of last year, but the volatility index just wouldn't come off. And what does that mean? That means that a lot of people were probably using the S&P 500 index options to protect portfolios. In other words, they were bullish, it seems, because the market was going up, but they were nervous. So some of that nervousness has subsided, and we're finally seeing some of the premiums come down on the S&P 500 index options, which has driven the volatility, or the implied volatility to be more exact, of the S&P 500 options lower. And hence we have a VIX that's trading below 18% implied volatility. Looks like it's probably going to close somewhere close to that going into a 3-day weekend in the actual marketplace. So a lot of good things that were said there. Now the VIX by itself isn't really a gauge overall, but when we see the VIX down at this level with the S&P 500 index at an all-time high, things for the first time since the big downturn last year are making a little bit more sense, if you will, as far in regards to volatility and indexes and setting new highs. Okay, so I digress. On Tuesday's Stock Play of the Day, we looked at a long call spread in the QQQ. Now, specifically, we were talking about the fact that the NASDAQ stocks have been a laggard as far as the last 2 or 3 months. And even though we're seeing the Dow stocks leading the market higher, even the SPX, a lot of stocks in the SPX going a little higher, even the Russell 2000 was a leader for a while, but it's backed off a little bit. The NASDAQ still was the laggard. So when we looked at the chart of the QQQ, I'm going to highlight now. We only had 2 days worth of trading, but more importantly, here was the chart that we showed on Tuesday. I didn't adjust any of these trend lines that are on the chart, and we were just saying that we were looking for either it's going to be breaking down or breaking up, and we were saying that if we get the break up, we want to have a lower risk trade that we have on, where the market could stay where it's at or go higher and we'd be profitable. And then we had a hedge in case it went lower. Well, in this instance, we obviously had to break out. We had a strong green candle yesterday, and we got another solid green candle today. So closing above this trend line that we had drawn here would be a good thing overall leading into the weekend for the marketplace. Now, that's just chart wise. We still have major news that's coming out tomorrow. We have the jobs report. And that's a highly anticipated and talked about jobs report. So who knows what's going to happen over the weekend? But as far as a charting and charting perspective, this was a real good candle. And if we can close anywhere close to where we're at overall, that would be good on a charting perspective. Okay, so let's get into our trade. It'll be short and sweet. Why? Because it's usually quite easy when your forecast is correct in options. It's usually quite easy to talk about overall. But we see right now the QQQ is at 324. It's up 1.5% or $4.87. On Tuesday's show, we looked at the underlying index was trading right about where our short strike is. And in the Ally Invest option chains, on the right-hand side, we see the calls. On the left-hand side, we see the puts. So we're going to focus on the calls. We sold the 313 strike, which was the at-the-money option contract. Then we went a little deeper in the money and we bought the 309 strike. Now, our goal here, even though we were doing a long spread, we were doing a debit spread to the account, was that we wanted to buy less time than we were selling. We wanted to buy less time than we were selling. And we accomplished that. We bought a lot of intrinsic value by going deeper in the money and less time value. And we sold the at the money. And that's where a lot of that bulk of time premium just sits. So in that instance, that meant that if the market just stayed where it was at or slowly drifted higher, we would be the benefactor overall. Usually that is the case when you have sold more time premium than you bought. Okay, so on that day, when we looked at it, I had a little screenshot saying that we were looking to pay $2.55 for that trade. I apologize for having to lean into it. My eyes aren't what they used to be. $2.55 for that trade. And right now, if we scroll down and look at the option strategy workbench inside our option chains, we see it's trading for $3.44. Now, we got a big jobs report coming up tomorrow, big news day, even though the markets are closed. So because of that, I would look to close out the trade. It would be quite simple. The maximum this can trade for is $4. It's trading for fairly close to $4 right now, $3. Well, 50 cents away. I wouldn't say fairly close. In the options world, 50 cents is a fairly big percentage of the total price. So instead of rolling this trade into the long call butterfly spread that we talked about or anything, I would just consider closing the trade and getting out of the paper trade. Now, as always, this is not meant to be a recommendation. We're just trying to learn here on the stock play of the day. But if I'm looking into it and I were to close it, this is how we would do it in the Ally Invest trading platform. We have the same trade on that we would place. I would go over into the right rail, and I'm going to scroll down here. And the buy to open now becomes a sell to close, and the sell to open becomes a buy to close. And we look to do this, I'd say, let's say $3.45, making approximately $1 on the trade. The maximum that the spread could trade for would be $4. So we're getting 55 cents less than the maximum. And overall, but then we're getting ahead of that headline. And I don't think it's worth losing this dollar on a $2.55 trade, right? Making $1 or approximately $1.90 on a $2.55 trade with this big of a news item coming out on Friday and the market's being closed and you can't react to that trade then. All right. So if we did that trade, we would just close it out. But overall, if we look at the profit and loss graph, right now we see that the market is up quite a bit higher than where our underlying strike is at. And that's what this is just highlighting. If we did go through the weekend, we might end up actually making that extra 50 cents, even if the market just stayed where it's at. But the odds are fairly low that it's going to do that with major news that's coming out. So that's it for this edition of the Stock Play of the Day Overtime. Don't forget to click subscribe and ring the bell, and we'll be back at the standard time next week, Tuesday at noon Eastern time, to tape the Stock Play of the Day. Thanks for coming, everyone.